Welcome to a quick session on deadly dangerous bonds. Not Alan, not James, but investment bonds. Let's have a quick look at what's been happening out there in the bond market in recent times. So, this is the Australian 10-year and the Australian 3-year bond rate. And we can see that after January 2019, bond rates have fallen, and that's been great for capital gains on your bond funds, and it's made your returns look quite spectacular over cash. But we're now in a situation where there is not a whole lot of protection out there if bond rates rise. So what does that mean? We've got some arrows here. When bond yields fall, when interest rates fall, capital gains are generated by bond funds. When rates rise, you get losses. So if we understand that, and we think about that for a moment, and we have a look at the green line there, which is the 3-year bond rate, where there is virtually no yield at all. No yield at all down there on the green chart. What that means is we have no cushion. We have no interest rate protection. So, because we like pictures, that's what this means. So where we've got high bond yields, we've got a large cushion, a large protection. So rates rise, that impacts our capital, but we've got interest rate coupons coming into the bank account and we can all live. Where we get low amounts of yield and rates rise, we get no coupon or very little coupon, and we lose our capital gain. So people say, oh, well, how bad can it be? So what I've done here is, if I can take my mouse over here and pull in a little spreadsheet that I've built, this is a bond valuation spreadsheet. And so what we have here is a $100 face value of a bond, and so we're buying it in the initial market. We're not buying it as a secondary bond. It's got a $100 value. It's got a redemption value of $100. Its coupon is 0.7, and the current rate in the marketplace is 0.7. In theory, it's a 10-year bond. It's got 4 coupons a year, and what we've done is we've taken our $100 and we have applied the interest rate across the years, and for our 10 years we're going to spectacularly receive $7 for our 10-year investment. And that's all great, except if we change the new rate here, let's say 1.25. So everyone's eyes have just dropped down the spreadsheet, but let's just hold for a moment. This is an actual change in the bond rate. So in 2020, the Australian Office of Financial Management was issuing government bonds for 10 years at 0.78%. In 2021, the AOFM is issuing bonds at 1.25%. So interest rates have risen. And what's happened down here is the value of our investment on a mark-to-market basis, move my little cursor, has gone to 94.84. Okay, so I've lost 5% of my capital. The only way I'm going to get that back is if bond rates fall back to 0.7 or below between here and the end of my maturity date. So what's this investor looking at? They're looking at a capital loss of 5.16, provided that bond rates stay at 1.25%. They'll pick up $7 for their from their coupon, and in 10 years they will have $101.84. Not very spectacular. But let's assume for a moment that interest rates, because the economy picks up and the pandemic's over and what have you, and interest rates, our friends at the Australian Office of Financial Management, they issue government bonds for 2%. That's to say that you're going to loan your money to Mr. Morrison and his crowd for 2% per year for 10 years. And let's see what happens here. We'll just push the enter key. Now we are looking at a thumping loss. Absolutely thumping loss. So if you convert that mathematics back and you think about the unit price of a bond fund, that unit price has now fallen 11%. So in your defensive portfolio, you have a loss of 11% on the way to 12. And your total return in our little calculator is 95 cents. Short end of the story is you need to focus on bond durations in your portfolios, and you need to start moving to short duration. If you've got any questions, call Matt Herbert in Advisor Services or give me a call. Thank you.